Hello, everyone, and welcome to episode 12 of the Lifespan Investment Series. Joining me again is Lifespan Investment Committee member, author, and publisher of the Payne Report, Jonathan Payne. Welcome, JP.
Thank you, Eugene.
A lot has happened since our last recording on 17 February. Geopolitical uncertainty has continued to skyrocket. Late February, of course, saw the Strait of Hormuz partially closed by Iran, which then, as we know, led to complete closure. Jonathan, for a long time, you've highlighted the possibility of this occurring and speculate on the damage it could do to global markets and economies such as Australia, which relies overwhelmingly on the Middle East for its supply of energy. How do you see this playing out?
Well, Eugene, I think we last had our video session together about 10 days or so, maybe 2 weeks before that fateful day on the 28th of February, 2026, which will always be highlighted, I think, in history. And as you say, what an extraordinary few months we've experienced. So the bottom line is, we have seen the effective closure of the Strait of Hormuz, this vital artery of energy, which supplies approximately 20% of the world's crude oil and about 20% of the world's LNG. And then you've got your fertilizer as well, and something between 30 to 40% of the world's fertilizer comes through the Strait of Hormuz out of the Persian Gulf. And if you go back to the 28th of February, I remember saying, actually, the Financial Review quoted me in the next few days, and I had described it in my first Payne report post the war starting as worse than my worst case scenario. As you know, Eugene, and many of the people watching perhaps will also know that I lived in the Middle East for 9 years. I've always had a fascination, a passion for the region. I first went there in 1986, and I study the region very, very closely. So all of us who have anything to do with the Middle East and or are involved in the energy markets have always known that the closure of the Strait of Hormuz would be a very, very significant and defining event. Well, here we are. We're making history. And as the head of the IEA, International Energy Agency, has said, this is unprecedented. This is the largest energy crisis in history. And now we are the 19th of May, and it's still closed. I'm sure all of you were awake at 5 o'clock in the morning, Sydney time, to see that President Trump, at 5 o'clock this morning, I was up, and he said, oh, by the way, I'm not going to bomb Iran tomorrow because the leaders of Saudi Arabia, Qatar, and the UAE have asked me not to. And this is yet another extraordinary moment where the President of the United States is basically telling us that he's going to solve this problem. The bottom line is this, Eugene. The President of the United States is unable to open the strait. And it's really up to the Iranians, because the Iranians still they have sea mines, they have drones, and they certainly have short-range ballistic missiles. And no vessels want to risk run the gauntlet and pass through the Strait of Hormuz. I've said from the outset of this that I really, really want to see more engagement by the Chinese. I do believe China is the only country that has the kind of leverage and authority and influence on Tehran to basically say, come on, guys, let's reopen the Strait of Hormuz. Asia, as you know, Eugene, heavily reliant on the flow of crude oil and also LNG through the strait. And we here in Australia, which you've already foreshadowed, import between 80 to 90% of our refined oil products, namely, of course, petrol, diesel, and aviation fuel. Now, it's really hard to capture the scale and gravity of what confronts us in a brief period of time. But I will just say this as quickly as I can. We're running down a lot of existing inventory of oil. We went into this war with very, very high levels of oil in storage, in fixed storage on land and floating, i.e. on oil tankers. We know that China entered the war with about 1.4 billion barrels of oil in reserve. They've been tapping into their reserves. They have reduced their imports, therefore consumption and purchase of oil in the open market. And at the same time, the United States has increased its exports of oil and refined products from existing inventories. And so what we've seen, I suppose it's kind of fortunate, the United States and China between them have basically created a situation by reducing demand in China from imports of oil and tapping into their reserves. And the United States basically refining a lot of their crude product and also exporting to the world, we've made up some of the balance. But right now, we still have a huge shortfall. So what that means is, in a supply demand framework, we're going to have to see more demand destruction, a decline in demand, and it's mainly going to come out of Asia and sadly developing Asia, Sri Lanka, Bangladesh, Pakistan, India, where we are seeing a significant reduction in demand. But the bottom line is, right now, what are we now? 19th of May. My best back of the envelope calculation is that if the strait is still closed at the end of June, we're starting to get down to, excuse the pun, the bottom of the barrel, the bottom level of inventories of existing energy around the world. And that's a moment where oil prices could go almost parabolic. Now we're sitting kind of comfortably above 100. We know since February the 28th, we've had some very sharp moves higher. We know the disconnect between so-called physical and paper, namely physical barrels of oil. That is when you and I receive a barrel of oil on our doorstep, Eugene, versus the so-called paper market, which is the oil futures market. We've seen prices $146, $147 in the actual spot physical oil market. The futures market is still basically saying this thing has to be resolved.
Mm.
Now, I don't know if it's going to be resolved anytime soon, Eugene, and that would just get me into all kinds of idle speculation. But I will say this. The regime in Tehran is still intact. The leadership might have been assassinated or killed, but the regime is still in place. And the son of the previous supreme leader, Ali Khamenei, the son is Mojtaba Khamenei, and we believe he is alive. Yes, he was very seriously injured on the 28th of February. Yes, we know the IRGC, the Islamic Revolutionary Guard Corps, are pretty much in control. The bottom line is this regime is still largely intact, and they have discovered a form of leverage that they had hardly ever dreamt of, because they now have control of the Strait of Hormuz, and they're going to, I believe, exploit that leverage and extract as much pain from the global community as they can. So we hold our breath. We hope and pray that we get some kind of resolution, that the strait opens in the next little while. But then we know, Eugene, once it's opened, the actual process of re-engineering all of the vessels and very large crude carriers, et cetera, will take some time.
Yeah.
So right now, we have no resolution. I don't see any short-term resolution, and I still look to Beijing to play a
Yeah.
critical role in this
And
process.
you've spoken about China's part to play as a potential, I don't know if it's a peacekeeper or just to find a way to end the conflict between the US and Iran. Um, and you've been writing about that in your pain report, which I read every week. Tell us your thoughts following last week's much anticipated meeting between Trump and Xi at the summit in Beijing. Did it live up to expectations? And how do you feel about any resolutions that may have come out of it?
Yeah, I can't tell you how excited I was in the lead up to the meeting in Beijing at the end of last week, Eugene. In my report, I described it as the most important meeting in the history of important meetings. Prior to the summit, I had said that basically all I was hoping for was a kind of equilibrium of disequilibrium. At the
Mm.
end of the day, these are two extraordinarily powerful nations. And I believe what we saw in Beijing last week was a meeting of equals. And it's the first time we've said that in the post war period. I believe the United States and China and what we saw in Beijing were two presidents, two extraordinarily powerful presidents. And in fact, I often reflect, I don't know how many people there are in the world, Eugene, but I think it's over 8 billion now, 8.5 billion or whatever the number. 8 billion people in the world. And yet there's two men who basically pretty much control our fate and our destiny. And we saw that on display in Beijing. President Donald Trump was his effusive self. He gushed constantly, and the Chinese state media gushed about how much Donald Trump gushed about Xi Jinping. And if you read the Chinese media, they were very, very happy to see how complimentary Donald Trump was. The President of the United States went to Beijing with very few cards. I was very amused by those who thought that America still has cards when it comes to China. And some people get upset with me when I say this. Let's remember the end of October 2025, we saw that meeting in Busan, South Korea. And just prior to that meeting, China had played its trump card, namely its rare earth critical mineral card, where they threatened to cut off the supply of critical rare earth minerals. And Trump went to that meeting and was extremely complimentary about Xi Jinping and lots of handshakes and lots of smiles. This time around, he was basically asking Beijing to intervene with Tehran. And it looks like, yes, China will be a kind of moderating influence, but there were no guarantees. No guarantees. And then on the transactional side, we're getting some evidence that, yes, China's going to buy more Boeing aircraft. Yes, they're going to buy some soybeans and some beef. And then, of course, the really sensitive topic that came up in the first few sentences of their first sit-down meeting, which went for 2 hours and 15 minutes. President Xi Jinping put on the table the T word, Taiwan. And then later explicitly asked the President of the United States, will you defend Taiwan in a situation of war? On the way back from Beijing, Donald Trump was in Air Force One and what we call a gaggle. A gaggle is when all the reporters assemble around the president in very close proximity. There's no, there's no formality, no teleprompters, and he answers any questions they fire at him. And he said, the last thing we need right now is a war 9,500 miles away. That's one of the first things he said to that group. And so the bottom line is this. We've come away from Beijing. I had a sigh of relief. And I think we have now, what I said before I was kind of hopeful for, was an equilibrium of disequilibrium, a kind of understanding that we have these two great superpowers. The last thing we want is any conflict, because it would be the last conflict that any of us would ever know. And at the end of the day, we have to live with each other. There are dependencies, there are interdependencies, and at the end of the day, we've just got to live with each other, respect our differences. And I think ultimately there was that understanding in Beijing. So, you know what? A sigh of relief, because, that could have gone wrong. That meeting could have gone wrong, particularly given the United States did that audacious abduction on January the 3rd, when they kidnapped Maduro, the president of Venezuela, an ally of China. And then, of course, they joined with Israel in bombing and going to war with Iran, another very strong ally of China. So there was some anxiety that President Xi Jinping was going to read Donald Trump the riot act behind closed doors and away from cameras. But it doesn't seem that happened. They even had a long walk in his rose garden, and the president of China promised to give President Trump some rose seeds to be planted at the White House. So we even had a nice, happy conclusion to the meeting.
No, very good. And do you think that from the commentary around the Taiwan, do you think that that was a little hint of what might be yet to come? I mean, there's always been speculation of the Chinese, invading or taking over Taiwan. They kind of almost don't need to, but is that how you took that? Or was it more of just a timely reminder that they could?
Yeah, it's a really sensitive topic, Eugene. I don't know if this is the right forum to dwell on it for too long.
No, fair enough.
But I came to the view a few years ago now that I'm just hopeful. I no longer believe that there's any prospect of conflict between the United States and China over Taiwan. That's my view.
Yeah, fair enough. Okay, cool. Let's move on to something perhaps a little bit more positive. And, well, is it positive? In my notes, the heading reads the AI earnings story versus the everything else story, which kind of sums up markets in a way. Emerging markets and US equities have been leading global markets since the start of the Middle East conflict, driven by strong AI-linked earnings. South Korea and Taiwan in particular have outperformed, while inflation-exposed sectors like materials have lagged. The AI capital expenditure story among the hyperscalers, who we know as Amazon, Google, Meta, Microsoft, and Oracle, is still running hard. Jonathan, how do you see this progressing throughout 2026?
Yeah, look, I'm still on board the AI train. You know my affection for Nvidia, which by the way reports on the 20th of May. So that'll come out 20th of May US time. So it'll be Thursday morning our time. So I hope everyone listening here will be up nice and early, waiting the earnings report of the greatest company in the history of greatest companies. I mean, Nvidia, is well above $5 trillion in terms of market value, led
Mm,
by one of the most extraordinary people, Jensen Huang, who, by the way, was with Trump, obviously, in Beijing. Um, Now, prior in the last few weeks, we had all the so-called hyperscalers. You just mentioned them: Microsoft, Amazon, Google, and Meta, announcing and re-emphasizing their commitment to increasing capex on the so-called AI build-out. And there's now some estimates that we will see AI-related capex in excess of $1 trillion in 2027. I think we're going to be about 850 or thereabouts in 2026 calendar year, but it'll go up to about a trillion in 2027. So let's just kind of pause and reflect on the enormity of that number. Whilst in the Middle East, we have an event which has never happened before, the Strait of Hormuz being closed, and we are also living through the largest energy crisis the world has ever experienced. We're now living through the AI transformative revolution and the commensurate massive, massive amount of money that is being spent to build this giant brain, which we can all equally access. So it's incredibly exciting. I say in all my speeches, Eugene, and you saw me speak obviously at your wonderful conference in Ho Chi Minh, and I said, just imagine a young girl growing up in a village in Burkina Faso, won't need to go to Harvard University because Harvard will come to her because each day she has access to the greatest minds, the
mm,
world's greatest minds. Her private tutors can be Einstein, Socrates, Aristotle, Newton, and we could go on. And that's what AI is all about. And every single one of us is going to have our lives changed by AI. So I'm a believer. I'm a huge believer. And we're seeing, as a consequence of this massive amount of spending by the largest companies in the world, that we're seeing beneficiaries of that. So Nvidia, of course, is the primary
mm,
beneficiary. But then you've got all the companies such as the Microns of this world and the SK Hynix and Samsung, who basically manufacture all the memory that is required. And then you've got hundreds and hundreds of companies that get involved in manufacturing all the components needed in the build out of AI. And
mm,
Asia is a treasure chest of these companies that manufacture these tiny little component parts. We've got fiber optics. And then, of course, you've got the commodity side, you've got copper. So there's a huge amount of money being spent, and there's a lot of beneficiaries. So the kind of so-called AI halo effect is very, very powerful. And that's being reflected in current earnings. So current earnings in the United States, which is completely dominated by
mm,
AI related companies, has far exceeded expectations. So you've got a Micron, which has gone up 3 or 4 times in price in a relatively short period of time, but is selling on a forward multiple, price earnings multiple of about 8.5 times. You think, how can that happen? But it's because, of course, the market keeps ramping up its expected earnings into the future. So the bottom line is the US market has been continued to be driven by the AI phenomenon, and earnings have been a beneficiary of the AI phenomenon. And this brings me to a topic which I've been highlighting in my pain report for several weeks now. It puts the spotlight back on what we were talking about last year, but kind of we lost our way. I'm talking about the market.
mm,
We used to talk about American exceptionalism. American exceptionalism was that, America dominated the world of AI, and it does. But this year, in 2026, we've not only got America winning and benefiting from the AI phenomenon, we've got America with being largely energy independent. So, in a relative sense, Eugene, in a relative sense, people have said, you know what? I'm not so keen on Europe anymore. I'm just going to go back into the United States. And
Mm.
we've seen a flow of capital out of non-US markets back into the US market. So the US market has done well this year, but particular sectors have done spectacularly well. And the other you raised, emerging markets, have done very, very well indeed. And we made an allocation last
Yeah.
year, or increased our allocation to emerging markets, I think in the third quarter of last year.
Yeah.
And emerging markets have done fantastically well. But a lot of that has been driven by AI related names, mainly and primarily TSMC, which is the largest company in the emerging market index, and then Samsung and SK Hynix. So the AI fountainhead of earnings prosperity has flowed through into emerging markets as well. And then you've got, Japan, for example, where again, I'll emphasize it again, is a treasure chest of these companies that manufacture components needed in the AI build out. So, yeah, the emerging markets have done well, and the US markets have obviously done well. Sadly, of course, our market here in Australia has not done well.
Yeah. Yeah. And it's interesting you say that because it's not just companies that are building AI, but it's the picks and shovels type. I refer to them
Yeah.
as picks and shovels type companies that supply AI companies with
Yes.
infrastructure and tools and materials that they
Yeah.
need. You're talking about almost 2 trillion US dollars in investment just from the big companies over 2026 and 2027, right? So
Yeah.
that's an enormous
Yeah.
amount of money that these companies can feed from, I suppose. Um, Moving on and maybe moving to equity markets a bit more broadly, they appear to be remarkably complacent despite the ongoing uncertainty driven by the conflict in Iran not having been solved. We talked about AI, but and you look at the US market; it's made an all-time high. I would I would I would suggest that a lot of that is being driven by AI related companies.
Yeah.
But more broadly, do you think that there's going to be a shift? Do you think that markets are a little bit complacent given it almost feels like the energy crisis and energy is something we perhaps don't have time to get into it today, but we've discussed it before. You need an enormous amount of energy to build AI because of the data centers and that all has
Yeah.
to be powered, et cetera, et cetera. So do you think that the equity markets, notwithstanding all the capex expenditure, um, in AI is becoming a little bit complacent. And do you think that the energy market is perhaps reaching a cliff over which we might just run out of? I mean, I'm kind of surprised that fuel prices in Australia aren't a lot higher than where they are now, given the scant reserves that we had. So, I mean, what are your thoughts? Do you think the equity markets broadly are just a little bit too complacent, or do you think they're sort of where they should be?
I think I, I'm I think Australia faces some very difficult months. We're getting hit by pretty much everything. Very, very a big pickup in inflation, a reserve bank that's raised rates three times. We're very, very vulnerable to the energy crisis, and we saw that initial sharp rise in diesel and petrol prices here. And now it's come off a little bit, but I'm afraid if we go to the end of June and the Strait of Hormuz is not opened, you're going to see our diesel and petrol prices go back to the levels we saw in March and even higher.
Mm,
We've been very lucky because, or the world has been very lucky, as I said right at the outset. China has decreased its imports of oil, i.e., it's not making purchases as much purchases in the open oil market, and they've tapped into their huge reserves. And we've been the beneficiary, as indeed the whole world has. And then the United States has also tapped into their reserves and are selling oil. Their increase in their oil exports and also refined product exports has been very significant. But that's because they're tapping into all these inventories. We are now losing an extraordinary number of barrels. So since the war, we've lost over 1 billion barrels of oil because of
mm,
the closure of the Strait of Hormuz. And it just so happens we have this kind of um, illusion at the moment that everything is fine because, of course, they've just gone in and tapped into the inventories that were there before the war started. But as time goes
mm,
by definition, those inventories are running down. Now, so that basically leads me to say this, that again, 19th of May today, in the next 4 to 6 weeks, I wouldn't be surprised to see oil trade at $150.
Well,
Now, the oil people, it's a really tough conversation to have, any conversation about oil. And it's since this war started that I realized that, the oil world is just a different world. And the oil analysts that I've spoken to are, wow. When they
yeah.
give you the arithmetic, it's pretty scary. So the oil analysts, the oil market would agree with you that we're all being a bit complacent. So basically, I would not rule out $150 on oil by the end of June. And if we get there, what does that do? It just
Mm,
accelerates the increase in inflation because the simple, undeniable fact is that every single thing that I can touch and feel in the room around me right now, every single tangible thing I can touch has arrived on a truck at this property. And diesel is the lifeblood of every economy. And Australia has the highest consumption of diesel per capita in the world.
mm,
We're the most dependent on diesel of any country in the world. Now, that means that we import the 80 to 90% of it. So as time goes by and inventories run down, you're going to have countries around the world that are going to try and ring fence and protect their own diesel.
mm.
And I'm afraid we're heading to that point. We're heading to that point. What does that mean? It means inflation rises. So we're now seeing producer prices around the globe really beginning to ratchet up because of higher energy prices, whether it's gasoline, whether it's diesel, whether it's jet fuel. And as a consequence of significantly higher inflation, central banks are now have abandoned any prospect of cutting rates.
Mm.
But as you highlighted earlier, this massive surge in earnings, driven almost exclusively by AI, has masked the kind
Yeah.
of inflation energy shock. So what we've all done is we've kind of gone, wow, AI. We only had eyes for earnings and AI. And we've kind of allowed this energy crisis to kind of hum along in the background and not pay a lot of attention to it. But I'm afraid as the next 4 to 6 weeks, I think the market will start thinking more about the rise that we've seen in bond yields. And I've been alerting my subscribers to this in the last couple of weeks. This very sharp rise in bond yields
Mm.
is significant.
And you think this is more of an Australian problem than a US problem, Jonathan?
I think I think we're acutely vulnerable because we
Yeah.
have chronic energy insecurity. Because of course we've had successive governments, and I'm not picking on any one particular government. I mean, decades of incompetence have consequences. And every Australian government, both Liberal and Labor in the last 20 years, allowed us to get to a situation where we only had 30 days of energy in reserves. And it's the lowest in the developed world by a very long way, in fact. So we're very vulnerable, and I'm afraid that we're seeing the push through inflation. And so we've got some difficult months ahead here in Australia. Now, in the United States, we saw the latest producer price numbers. PPI rose at an annual rate of 6% in the month of April. And that's a real sharp rise from levels we saw in 23 and 24 and 25. And even in China, for the first time, don't quote me, but I think it's something like 46 months, we saw a positive PPI number. And in fact, we saw a sharp acceleration in producer prices in China and in Japan. And so I'm afraid these higher energy prices, and because the duration of the closure of the Strait of Hormuz is now pushing inflation up, and that has also fed into higher bond yields, Eugene. And we've been quite negative at Lifespan on long-term bond yields, but they've really gone up in the last couple of weeks.
Yes, indeed. Um, we've talked a little bit about the impact on Australia, but let's talk just briefly about the RBA and inflation in Australia. So the RBA has come out and said they expect headline inflation to peak at about 4.8% in mid 2026, with underlying inflation remaining below 3% until mid 2027, driven sharply by higher fuel and raw material costs from the Middle East conflict. They raised the cash rate to 4.35% in May. It's third hike this year, as you said earlier, and markets are pricing a further rise to 4.7%. So markets are sort of pricing definitely another one rise, and possibly, maybe a 50-50 chance of a second by the end of the calendar year. So what do you think about all of this? Do you think that that's likely what's going to play out? And I mean, it doesn't look as though other countries are talking about aggressively raising rates in the same way that Australia has. They've kind of pivoted from expecting rate cuts. And actually, late last year, we were probably expecting rate cuts in Australia for 2026. But other countries are sort of now preparing everybody for no rate cuts. Maybe they'll have to raise rates, maybe they won't. But this probably puts Australia at an even further disadvantage. And yeah, I've taken note of what you've been saying about our fuel reserves being incredibly low relative to the rest of the world, and certainly the rest of the developed world. So yeah, I mean, that kind of adds, excuse the pun, but fuel to the notion that Australia is probably going to struggle more than other countries.
Yeah, I think so. It's yeah, I think I'm afraid I agree with that assessment. I think Australia is going to struggle. As you say, we've had three consecutive rate hikes. I think Michelle Bullock will probably have to do another one, and there'll be the possibility of a fifth one. But the bottom line is, yeah, it's the economy is slowing here. I mean, anecdotally, I'm speaking to a number of people just in the last couple of weeks, and people on the front line of, in the property market, developers and people like that are saying, wow, things are
Yeah,
slowing here. And then, of course, the Australian budget probably didn't help either. So, yeah, you've got an unfortunate mix of circumstance here. And there's some speculation that we're kind of moving into a messy stagflationary
yeah,
environment of higher inflation and very, very anemic growth. So, yeah, I'm sorry to say that I probably agree with that. And then, as you were saying, the the Europeans are going to raise rates next month. The
right.
Bank of Japan is going to raise rates next month. The Fed, remember, Eugene, at the beginning of the 2026, the market was pricing with certainty that the US central bank would cut the US federal funds rate two times in 2026. And there was even the possibility of a third rate cut priced in 2026. Well, those have all been abandoned. And and
Yeah,
and, and let's just acknowledge that Kevin Warsh is now the new Fed chair. And I don't think Kevin Warsh, when he basically expressed his desire for the job, could possibly have imagined that as soon as he becomes the Fed chair, he is going to enter a meeting with his colleagues on the FOMC where there may be actually a call for a rate hike
yeah.
by the US Central Bank. Now, just imagine if Kevin Warsh raises rates, what will Donald Trump do? Well, we know what he'll do. Um,
He'll
yeah,
throw a
so
hissy
the
fit.
the money, hey,
I said he'll throw a hissy fit.
he will, he'll take to Truth Social, and it'll be
Absolutely.
an entertaining read. So the central bank and monetary policy landscape has done a complete U-turn in 2026 as a consequence of higher inflation. And the
Yeah,
one thing the central banks don't want is for inflationary expectations to get away from them.
yeah,
And so as a result of that, you're seeing long-term bond yields rising sharply, yield curve steepening around the world. I mean, the long end in the UK, we haven't spoken about the UK. I mean, the UK is a disaster. And
mm,
I've been writing about that for some time in my report. It gives me no pleasure whatsoever because I've got quite a few British subscribers who asked me to take it easy. But I mean, the writing was on the wall that Britain is in trouble. We've got political turmoil, we've got a declining British pound, and rising UK government gilt yields. So yeah, I mean that's the kind of the world around us is one where there's more tension now between bond markets and equity markets. And last Friday, the price action on Wall Street on last Friday was a bit of a wake up call for me. And I said that in my report on the weekend that maybe we've just crossed over into that new terrain where the rise in bond yields is getting the attention of equity markets now. And I think as a
Yeah.
result of that, these next few months are going to be could be very turbulent. And one more thing, sorry, Eugene, one more thing. Every Fed chair, and I've watched a lot in that job from 1984. Every single Fed chair that I've seen since 1984 has been tested by Wall Street early on in their tenure. And I think Kevin Walsh is going to be tested by Wall Street. Now, I can't explain to you why Wall Street always tests a new Fed chair. Maybe it's just a game they play, but I've seen it. I remember them all. And I think Kevin Walsh is going to be tested in his first few months in office.
When you say tested, you mean Wall Street sells off and
Yeah.
sees whether or not the so-called Fed put is still alive and well, still in play. Yeah, okay.
Yes. And I think the bond market will basically knock on Kevin Walsh's door at the Eccles building where the Fed resides and remind the US central bank who's the real boss, because the
Hmm.
bond markets are the ultimate boss.
Right. Okay. So there's a lot there to consider. Perhaps more uncertainty than anything else, and we all know how much markets don't like uncertainty. Let's move on and talk about the lifespan managed portfolios. So since we last spoke, we haven't actually made any changes to our SAA, our strategic models. We've had several meetings. We meet monthly. We've had several meetings, and in each one, we've obviously discussed what's been going on, whether or not our portfolios needed to have changes. And our assessment was that we're reasonably well positioned. We're a little bit underweight growth. We had an overweight position to property and infrastructure, which is not a bad place to be when you've got high inflation. We're underweight Aussie equities, and and we're overweight. Well, relative to Aussie equities, we're overweight global equities, and I think if you've got a lot of global equities, you can't help but have a lot of US equities. And in particular, we do have some diversification around the big tech companies, but we've got plenty there. We've also, as Jonathan mentioned earlier, had an overweight position to emerging markets since late last year. So our assessment has continued that we haven't really needed to change. I think in times such as these, your best friend, I think, is diversification and probably quality. Quality stocks
Yeah.
haven't actually performed that well. And that's probably caused our portfolios. They've still done okay. They've held up, but perhaps not to have done as well as they have in the past. But when you go through difficult times, you probably want companies with strong balance sheets and good long-term diversified investment strategies. So we've retained that positioning, not for all of our portfolio, but for a significant enough part of our portfolio. And then, of course, in the fixed interest and defensive space, again, quality is king. And as Jonathan mentioned earlier, we've been underweight long-term fixed term duration, both in Australia and the US or globally. And we've had a good exposure to high quality credit, mostly floating rate credit. We haven't dipped into the high yield space, your lower quality bonds. Um, but we have actually allocated sort of late last year or early this year to a manager that can tactically go into that space. But for the most part, we're quality, lower duration than the index. So we're quite happy with how that was, and we haven't felt the need to make any changes. Notwithstanding, we're always looking at it, and we're always reviewing the various fund managers that we have in there. On the tactical asset allocation component of the portfolios, we've taken the opportunity to increase our exposure a little bit to growth, and we've done that in three small pieces of buying in March and April. So that's been fine. But again, we're still underweight, a little bit underweight in that portfolio. So, and again, very, very diversified. Jonathan, anything you wanted to add to that?
I don't think so.
Yeah.
What have we covered? We've covered the world, haven't we?
Pretty much, pretty much.
I
That's a lot
think,
in
I
45
think,
minutes or so. But yeah, no, I think that's a snapshot of where our portfolios are, and hopefully we've covered off on some of the major issues and helped you all with your portfolio allocation. But as always, it's probably times like these where it's really great to have an advisor to be looking after all these things for you. So, and with that, I might leave it there. Thanks again, Jonathan, for joining us. As usual,
My
it's great
pleasure.
to hear everything you've got to say around geopolitical events and their impact on markets. And to everybody listening in, thanks again for listening in. And if you have any questions about any of this or anything else to do with your investments, please contact your financial advisor. And as always, if you don't have an advisor, you can contact Lifespan and we can help you find a really good one. So thank you again and all the best.
Thank you, Eugene.